and going to the next schedule here, what you can see is, in my opinion, the Fed is done. Point is, if I'm correct and the signaling they've been giving us is correct at 5.25, what's going to happen next? We know they're going to cut rates. What's going to happen to gold? It's going to rocket. It's going to go through 2000. It's not going to look back. Having seen these cycles, I can tell you this is a bubble that's burst, and so gold's been just bumping up against its all-time high. We've now had kind of a triple top. This could be a quadruple, but there really is no such thing as triple tops, and to me, it's just a matter of time until gold breaks up and goes. I think we squirt to 2,500 easily, eventually 3,000. And, I mean, eventually it's got to be 5, 10, 15, 20 if we do a monetary reset. If we covered the entire monetary base with gold today, the math is you'd have to be at an $87,000 an ounce gold price. Now,
Federal Reserve officials have shown increasing confidence in not continually raising interest rates to combat inflation. However, they have not reached a level of satisfaction to conclude the hike or initiate discussions about lowering rates. In the recent announcement, the Federal Reserve maintained steady rates, a move widely anticipated by experts. Lawrence Lepard, a proponent of sound money, heavily criticizes the Federal Reserve, alleging a pattern of deception where their statements contradict subsequent actions, especially regarding interest rate plans. He suggests that this misleading communication perpetuates a flawed economic system at the expense of the public. Chair Jerome Powell stated that the U.S. monetary policy was slowing the economy as expected, emphasizing that the benchmark overnight interest rate was positioned well into restrictive territory. He highlighted that a key measure of inflation averaged 2.5% over the 6 months ending in October, close to the Fed's 2% target, as reported by Reuters. Lawrence stresses the current inflation issue, warning that even though the Fed appears committed now, it would resort to printing more money to stabilize the economy if the bond market faces a downturn. This week, gold prices surged to a 6-month peak due to a weakened U.S. dollar and speculations that the Federal Reserve had concluded its interest rate hike cycle. Lawrence highlights gold's historical role as a reserve asset, noting its decline post the gold standard but recognizing a renewed interest, particularly after the 2008 financial crisis. He criticizes the prolonged period of near-zero interest rates since 2008, attributing it to economic principles leading to currency devaluation. There has been a global trend in central banks accumulating gold reserves, reflecting a growing skepticism towards traditional currencies and a preference for gold as a hedge against economic uncertainties. Lawrence predicts that this surge in gold purchases might exceed records, signifying a global decline in confidence in fiat currencies. We will present clips from Lawrence Lepard's interview with ITM Trading. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
But remember, the Fed are habitual liars. I mean, this is a guy who said they weren't even thinking about raising rates, and then they turned around and jacked them up 500 points in a record period of time. I mean, these guys lie for a living. That's what they do. They're out there to try and keep their broken system going and to cheat the rest of us. And that's the game. And you can be sure right now inflation is the major problem. So he's being a tough guy.
Yeah.
But guess what? When the bond market goes no bid, as it almost did in March of 2020, and as it's kind of done a couple of times since then, they're going to turn around and print. There's just no doubt about it.
Mm-hmm.
So assuming that's the case, this is an interesting chart. Let me just explain what this is. The blue line is the Fed funds rate. And what it shows you is, coming into, should have gone back further, but coming into 2000, they knew they had a bubble and they were jacking Fed funds up. They got them up as high as 6.4% or something, 6.25%. And then, but then the market rolled over, right? We had a dot-com crash and they rapidly cut rates. And the orange line is the price of gold. Look at what happened to the price of gold during that period. It doubled. Okay. And then, so then they cut rates down to 1% and they created, the dot-com bubble burst. They created a housing bubble, and Bernanke said that. Remember, Greenspan and those guys going out and encouraging people to get HELOCs. I mean, it was sick. It was totally sick. And so they created an enormous housing bubble, but then they started raising rates to deal with that, right? And then that broke in 2008 and bang, they took rates back down to zero, okay? And of course, look at what happened to the price of gold following that. Okay. And then, then they printed QE and a lot of people say, well, how come there was no inflation with QE? It's because it was really an asset swap and the money they printed went into the everything bubble, which were stocks and bonds and not into the stuff bubble, not into food and so forth. And so as a result, they had low printed inflation, but high asset inflation during this period. And of course, the gold people got hammered, including me. This was like one of the toughest periods of my
Mhm.
life, but it is what it is. Good news is I got so pissed off, I got in shape because I decided I want to be around for the final round with these assholes. And so I better get in good shape. That's what got me into CrossFit. So
CrossFit.
yeah,
Yeah.
there was a silver lining to this, even though I watched my net worth go down by 50%.
Wow. Yeah.
Yeah, it was brutal. It was absolutely brutal. But here we go. Now we're in 2016, and sure enough, they start raising rates again. Well, how did that work out? Up, repo crisis, COVID, bam, back down to zero, and gold takes off. Okay, so here we are. Now we're up, and this should be up over 5.25. I think it's a little out of date, but the point is, if I'm correct and the signaling they've been giving us is correct at 5.25, what's going to happen next? We know they're going to cut rates. What's going to happen to gold? It's going to rocket. It's going to go through 2000. It's not going to look back. And so here you can see this is a fabulous chart. Gold is a percentage of global international reserves, basically what countries have held to protect their currencies from 1880 to present. You can see back in the gold standard days it was 90%, 80, 90%, and that started to fall post World War II, but it was still up there fairly high. And then, of course, when we went off the gold standard, that was the beginning of the end. And of course, gold price rallied a lot, brought it back up. But now look at where we are. I mean, this is the net purchases of central banks. And notice how during the 80s, they were sellers. They're like, who needs gold? I mean, as you recall, Britain sold all their gold, Canada sold all their gold. Nobody needed it. We live in a deflationary world. You don't need gold. Somewhere along the line, that changed. People saw with '08, and if you notice, actually happens to kind of correspond with '08, which is when I got really radicalized for sound money. I mean, Danielle, we've been running an enormous experiment since '08. I mean, the notion of ZERP, of having 0% interest rates, it's like a crime against capitalism. We had 0% interest rates from '08 to 2015. Then they started to bring them up. Then they had to cut them again in 18. Then they really cut them in 2020. And now, of course, they jacked them very high. But the point is, the central banks in other countries realize what the U.S. is doing, which is debasing its currency. And that's why you see this trend in gold purchases. And we were at an all-time high last year. And I think this year we're set to exceed the all-time high as well.
The Federal Reserve's current stance of holding steady rates allows individuals to address high-interest debt more effectively. Lawrence foresees that the Fed might intervene proactively by becoming purchasers of excessive debt to prevent potential issues from escalating. He also speculates on the potential implementation of yield curve control as a preventive measure against interest rates spiraling upwards. Reflecting on recent market trends, Lawrence discusses the Federal Reserve's reaction to a potential loss of control in the Treasury market. He highlights a prompt response from the Fed, characterized by their use of verbal interventions to indicate a cessation in the escalation of rates and a likelihood of future rate reductions. Additionally, the rise in Treasury yields, accompanied by the weakening of the U.S. dollar, appeared deliberate in its aim to devalue the dollar intentionally. Recent diplomatic exchanges between China and the United States could influence this strategic maneuver. Lawrence suggests that the Fed acknowledged potential errors in their tightening policies and hinted at an imminent shift back to monetary easing. The printer is coming to counteract the perceived economic challenges on the horizon. Let's get back to the interview.
Well, I mean, what I think they will do, what they're going to have to do to keep things from blowing up is they're going to have to become the buyers of that debt. And they're going to have to invoke yield curve control because otherwise interest rates are going to go higher and higher and it's going to be a death spiral. And so my sense is that they will do that. And they will try all kinds of draconian measures. I mean, they may force people in the US who have IRAs and 401ks to buy government bonds. They may, tax people who hold gold and Bitcoin. They may, they know they're not all stupid. Some of them are, but they're not all stupid, and they know what's coming. And so, they're going to use the CBDC to implement UBI. I mean, hell, they tested UBI in COVID. I mean,
Hmm.
and so they're likely to use, okay. And everyone's gonna say, well, I don't want a CBDC. Well, if you're poor and you can't buy food, and they're giving you a CBDC, and that's the way you get your money to buy your food, guess what? You're gonna take a CBDC. Now I'm not gonna hold if they give me anything in a CBDC, I'm gonna instantly swap it out for, something that's real. But the average human being might not do that. And by the way, they might prevent me from doing that. They might say, here's your CBDC payment, and you can only use it for food, or whatever it might be. But they've got a lot of levers, and really, Danielle, it's so far gone that I don't think there's any way they can come out of this. But I will say, when people ask about investing in my funds, they ask me what could go wrong, and I will tell you what could go wrong, and you'll laugh, and they do too. But what could go wrong is if suddenly the U.S. federal government got incredibly responsible and decided to means test Social Security, means test Medicare, cut all these military bases, cut military spending, balance the budget, have a balanced budget amendment, and or maybe do some kind of a monetary reset like Roosevelt did, to gold or something sound or a basket of commodities, that might stop the incipient high inflation problem that I believe is baked into the cake. But when I tell people that, they kind of smile knowingly, just as you did, like, what are the odds of that, right? I mean,
Uh,
these people are idiots. The odds that they do that are not very high, right? Or at least
well,
until we feel more pain. It appears to me, I mean, they were losing control of the treasury market, right? I mean, the 10-year was up through 5.0%, and we were starting to look the way that the British market looked in the fall of last year, where the pound was falling and the British gilt was spiking up in interest rates, and so that was kind of starting to happen here. And it was rather amazing the way the Fed reacted to that. I mean, I think they had like 11 speakers out in the period of a few weeks, basically saying, we might be really close to the target on what we need to be in terms of tightening, and sending a strong signal that they were through, that the Fed is done hiking, and that in fact the next move is likely to be cuts. And if you look at the CME Treasury futures odds, the odds are overwhelming that they are done and they are going to start cutting. At least that's what market participants are saying. And so if we're going to have cutting of rates, and if you believe that the economy is slowing down and there's a recession coming, and I think that's becoming a little bit more of a consensus view as well. I've been saying it for 6 months to a year, but most people were denying it until recently. Then suddenly there's a bid in the 10-year. And then if you add in one other factor that I think is somewhat important, is I think this recent visit by China to the United States,
mm,
Roman is really the best at outlining how this has happened. I think that recent visit led to a conscious decision to try and weaken the dollar. And one of the things you notice that's happened in the last month or two is, the treasuries have caught a bid, and so yields are down, as you said, 60 basis points, but in turn the dollar is off substantially in the same time frame. So I think the Fed realized they were in trouble of having gone too far and having tightened too much, and thus they sent the signal to the market, oh, no, don't worry, the printer is coming.
If the Federal Reserve opts for earlier rate cuts, the Bank of America has predicted that gold could culminate the year at an impressive $2,400 per ounce, marking an 18% surge from its current levels. How might the recent actions and criticisms directed at the Federal Reserve influence public trust in monetary policies and impact economic stability? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.